All right, let's just dive right into this explainer. Today, we're going to completely demystify the financial mechanics that dictate a company's true value. We're essentially building a pyramid together, starting all the way down at the bedrock of clean bookkeeping, moving up through the absolutely crucial layer of tax compliance, and going all the way to the top to secure a premium valuation multiple when you're finally ready to exit. So whether you own a business, plan to buy one, or you just love understanding how money actually flows through a company, you are in exactly the right place. But first, I've got to start by asking you a question. And honestly, it's one that trips up countless e-commerce entrepreneurs. When you check your bank account and you see a direct deposit from a platform like Amazon, is that payout actually your revenue? Most sellers pop champagne when that number hits the bank, and hey, fair enough. But here's the harsh reality. That number is not your revenue. It literally never was. It's an illusion. And treating it like revenue is the foundational problem that destroys the accuracy of your books right from day one. So here's our roadmap for today. We're going to tackle the net payout illusion, then deal with deal-killing sales tax, unpack SDE versus EBITDA, and finally look at maximizing your business value. Let's start at the very base of our pyramid. Section 1, the net payout illusion. Okay, think about two entirely different financial realities. First, you've got gross sales. This is the complete revenue picture, the total amount customers actually paid for your products. Then you have the net payout. This is just what's left over after the platform quietly scrapes away referral fees, fulfillment costs, ad spend, refunds, and reserves. The single most common bookkeeping mistake sellers make, recording that net payout directly as their gross revenue. When you do that, you're completely hiding vital gross margin data. You are literally flying blind. To put this into perspective, imagine a typical Amazon FBA settlement. Say the net bank deposit is $2,600. If you just log $2,600 as revenue, your books are instantly wrong because your true gross product sales were actually $4,200. The difference between those two numbers is $1,600 of expenses, fees, and liabilities that just vanished from your profit and loss statement into thin air. To build a truly valuable business, you have to break the settlement apart and map every single component to its correct ledger destination. Now, once you're tracking gross sales correctly, you have to decide when to actually record them. Cash or accrual accounting. Cash accounting is simple, right? Money in, money out. But if you hold inventory, it massively distorts your profitability. Imagine buying 10,000 units of stock in November for a huge Q4 spike, but you don't actually sell them until January. Under cash accounting, November looks like a catastrophic loss, and January looks artificially amazing. Accrual accounting fixes this. It matches the cost of the inventory to the exact period the unit actually sells. Plus, according to the IRS, accrual accounting is generally required for businesses that purchase or sell merchandise anyway. It's really the only accurate way to track true inventory profitability. Moving right along to Section 2, deal-killing sales tax, otherwise known as your compliance shield. Because here's the thing, pristine bookkeeping means nothing if hidden liabilities blow up your M&A due diligence. And the crucial point here revolves around a concept called nexus. Nexus is simply a physical or economic presence in a state that triggers a legal requirement for you to collect and remit sales tax. You don't even need a warehouse there. Hitting a threshold like $100,000 in sales or 200 transactions is often enough. But here is the truly terrifying part that catches sellers way off guard. If you never file a tax return in a state where you have nexus, the statute of limitations never starts ticking. That means unpaid tax liabilities can silently compound in the background for years. Which brings us to the ultimate buyer nightmare, successor liability. A lot of sellers just assume, well, I'll sell the assets of my business, and the debts will stay with me. Wrong. Because of successor liability, a buyer can actually inherit the pre-transaction sales tax debts of the business they just acquired. Unless you follow very specific statutory bulk sale notification procedures, the state is absolutely going to look to the new buyer to pay the old seller's tax debts. When buyers discover this during due diligence, panic mode. They'll either demand massive amounts of cash be held in escrow, or they'll just kill the deal entirely. But hey, there's a proactive fix. If you do a nexus study and find some skeletons in the closet, you can use what's called a voluntary disclosure agreement, or VDA. By coming forward to the state voluntarily before they come looking for you, you can often settle those past due liabilities, get the penalties totally waived, and most importantly, limit the look-back period to just 3 or 4 years. Smart sellers use VDAs to clean up these deal-killing exposures long before a buyer's due diligence team ever starts digging around. All right, Section 3. SDE versus EBITDA. This is your valuation reality check. Most owners walk into a sale armed with some generic multiple they found on the internet. But if you take a look at the breakdown of sellers' discretionary earnings, or SDE, it tells a different story. A restaurant might trade around a 2.24x multiple. A small HVAC business, maybe 2.79x. But a car wash, it's commanding nearly 5x. Why the huge gap? Because buyers price in risk and barriers to entry. Restaurants are incredibly risky with high failure rates. Car washes, on the other hand, are heavily zoned, capital-intensive, and often have tons of recurring membership revenue. So it's not just about what industry you're in, it's about the underlying economics of your specific business model. But here's a secret that honestly surprises a ton of founders. Deal size moves the valuation multiple way more than the specific industry does. Data from the IBBA Market Pulse survey shows that a business valued under $500,000 trades at roughly 2 times SDE. But when you jump to a business valued between $5 and $15 million, it trades at an average of 6.5 times EBITDA. As a business scales up, it becomes a much more secure asset. It attracts institutional capital, and that multiple just expands dramatically. Now, did you catch the shift in the metrics we just used? We went from SDE right over to EBITDA. That shift happens right around the $2 million revenue mark, or roughly $500,000 in profit. That's the magic threshold. That's where the valuation math fundamentally changes, because the type of buyer fundamentally changes. Let's break down why this matters for your valuation strategy. Under $2 million in revenue, buyers use SDE, seller's discretionary earnings. SDE basically adds the owner's salary back into the profit because the buyer is usually an individual who plans to step in, roll up their sleeves, and replace your labor with their own. But over $2 million, now you're attracting financial buyers and private equity. They use EBITDA. And they definitely aren't going to run the daily operations. They have to hire a market rate manager to do your job. So EBITDA strips your compensation out of the profit. It is the exact same business, but completely different math, based entirely on the hired manager analogy. Finally, Section 4, maximizing your business value. How do we actually push your business from a low-end average to a massive premium valuation? Well, there are 6 operational levers that dictate whether you get a 2x multiple or a 6x multiple. Think about recurring revenue for a second. An HVAC company relying purely on new construction is incredibly volatile. But an HVAC company sitting on hundreds of annual maintenance contracts, that trades much higher because the future cash flow is locked in and predictable. Buyers also pay major premiums for high barriers to entry, like needing a specialized master's license, and low capital intensity, meaning you don't have to keep buying heavy machinery just to grow. Conversely, they will heavily discount your business if you have high customer concentration. Say one client makes up 40% of your sales. But they'll pay top dollar if there's active private equity interest rolling up your specific sector. But honestly, out of all those levers, this next one is absolutely make or break. A business that does not run without the owner is functionally unsellable above 1.5x to 2.0x SDE, no matter what industry it is in. I literally cannot stress this enough. You could have a wildly profitable contracting business, but if you're the one answering every customer call, writing every single estimate, and managing every job site, you don't actually have a business to sell. You just have a very demanding job. Buyers will sprint the other way if the operations halt the second you take a vacation. You have to build a transferable system with a real team in place. Which leaves us with one final, pretty intense question for you to chew on today. If you just walked away from your company for 3 months right now, would your business actually grow in value, or would it just completely cease to exist? If you've laid the groundwork with clean accounting, mitigated your tax risks, and built systems that run like clockwork without you, you're sitting on a highly transferable premium asset. But if not, well, it's time to start building your value pyramid. Thanks so much for joining me on this explainer, and I'll catch you on the next one.